Hi guys, this is Jed with azrealtyguy.com. Wanted to take a few minutes to run over this housing report that we got from Michael Orr, who is over at the Cromford Report. This was released earlier in the month and illustrates very well what is going on in our current housing market. A lot of sellers out there are having a very difficult time selling their home and capturing a buyer, and that's in large part due to the fact that we've changed from a seller's market to being in balance from November to the first week of February, and now we are officially in a buyer's market. So let me run through this report real quick. I think it'll help out. So the first page here talks about the normal market cycle and how we have optimism and exhilaration and euphoria, and then all of a sudden we start to become uneased and we start denying that we're actually having a downturn, and some pessimism, and then panic, and then despair. And then we go through that cycle over again. Well, we are just coming out of the euphoria and unease section, and now we're in the denial and pessimism section. And this is going to lead to a market correction. So here's the monthly average sales price per square foot in the greater Phoenix area, measured monthly. And it starts back in 2001, where we had an average price per square foot in the valley of $99. And then you can see during the boom, we shot up to $190 on average for the valley price per square foot. And then we plummeted starting in about 2007. And then we hit about rock bottom, I would say 2011 at $79 a square foot, the summer of 2011. And that's when we experienced the moratorium here on foreclosures, and we adjusted. And this is where a lot of the investor buying started to occur, and we shot back up, and we are currently at about $129 a square foot. And normal inflation puts us about right in line. So this slide shows that we have another approximate 47% to go until we reach the peak in pricing value. So when people ask if we were in another bubble, we still have a lot of room to appreciate before we get to the levels that we were at the height. And the recovery was based on actual real funds where people had to qualify for a loan and show that on paper. And almost 46% of all of our closed sales in the past couple of years have been built on cash. So what controls the housing market? The supply and demand. Prices move up or down until the demand is in balance and supply is in balance. And this is just a quick one-liner. Prediction is very difficult, especially about in the future. And here is what the Cromford Report does very well. They give you an idea of what's going on in the market by giving a market index. And the market index shows that when we are in the green, we are in a seller's market, where we have, and that's above 110 on this gauge. And that means that the inventory is low and the supply is low and the demand is very high. Once we get between 110 and 90, that's considered a normal balanced market. And then below 90, we have a large supply and the demand is low. And these two other gauges kind of break that down a little bit to show that what contributes to the general overall market index. And here our demand is a lot lower than what our current supply is. We still are not at normal supply levels, but the demand is so low that it makes it feel like there's a lot of supply out in our current market. And this just shows 6 months ago how it relates to that, where we were in a very much seller's market. We had a really good amount of demand, or a normal amount of demand, but the supply was so low that the demand offset for the supply and created a very good seller's market. So this shows the Cromford Market Index since August, and how we went from a seller's market, a very strong seller's market back in August, where we were at 150 on the Cromford Report Market Index, and we've steadily been sliding down. And in November we reached about a balance. Actually, it was a little bit before November when we hit 110 and below, because 110 to 90 is a balanced market. So we were in balance for November, December, and January. And then the first week of February, we fell out of the normal market and went into a strong buyer's market. So this shows the market rankings. Sun Lake still is in balance, as well as PV, Chandler, Sun City. And then we start getting into a strong buyer's market in Cave Creek, Gilbert, Phoenix, and Surprise, Queen Creek, Maricopa. So currently this is a graph showing the active listings, or our supply, and normally we like to run between 30 and 35,000 homes is on average the normal supply levels, and then we sell anywhere between 5,000 and 6,000 homes a month, and that gives us about a 6-month inventory. You can see our supply was really low here and then dips way down in 2004, between 2004 and 2005, and then steadily starts increasing, and this is in result to a lot of home building. A lot of home building went on in the North Phoenix area, in the Southeast market, Queen Creek, Santan, Gilbert, Chandler, and we reached the height of our inventory in about 2011, had a little bit of a dip, and then we had some of those 3-year arms hit that shot up our inventory again, and then we've been steadily dropping down. But now the inventory levels are starting to rise at the end here, as you can see, and that's in part due to rising pricing. As prices rise, the demand tends to fall. So, and this shows what the trend lines are, and it shows where our low supply areas are according to that trend line. And again, this shows the active listings color coordinated to the years, and where we are currently, and that we are below normal inventory levels for the valley, but yet the demand is so low that it feels like the supply is high. So in summary, we are rising about 500 listings per week, and our normal market usually peaks around February, and in a strong market in January, and in a terrible year in the fourth quarter. Ooh. So let's talk about demand. Here are the recorded sales per quarter, and these do not include the new homes. And again, our per quarter, so every 3 months, on average, we want to have about 18,000 sales or 6,000 sales per month. So this breaks it up into investor and owner occupied. It shows that we had a large investor contribution here recently in the past few quarters, and predominantly it's been owner occupant. And you can see here, this is at the height of the market in 2007, where very few people were buying, including investors and owner occupants. And this is the sales per quarter and just the new homes. And as expected, at the bubble, things really plummeted for new home sales, and they reached their bottom at 2011. And then we see the new home sales start to creep up a little bit as builders were applying for permits again. And these are recorded sales without investors and excluding new home sales. And again, shows you that we're about 16,000 homes on average that we sell every quarter. So pending sales is a very good indication of what our current demand is. And you can see here that the demand really started to suffer back at the bubble and then rose up in the few years after. And here again are these peak months in the first quarter. But at the I would say probably halfway through 2013, we really start to plummet, and the demand really starts to fall off. And that's because, and here is probably where the bottom of the interest rates were, and as they started to creep up and prices crept up, the demand started to fall. So here are pending listings, color coordinated to year, and we are still pending about 6,000 listings here, but in some of the stronger years, we were well up into the 8,000 and 9,000 pending sales. So why is the demand below normal? Investors, their interest in the market drops when prices rise. That's because their return on an investment decreases. The affordability is good, but it's much worse than what it was last year. Many people missed out on the low interest rates, even though they still are historically low and below the 7% average. People still can remember seeing 3% interest rates, and now a 4.5% or 5% interest rate seems very high. The household formation is extremely weak. That's a lot of the millennial generation. They're saddled with student loan debt. They would rather rent versus own, and they've also seen what the short sale and foreclosures of the past few years have done to their parents and totally wiped out their wealth. And this is a really good graph showing where interest rates are and back around when I was born, when they were 18%, and how they've declined steadily, and we reached a bottom apart in about summer of 2013, or actually that was about May or March of 2013, and then we shot up within about a month's time, and we've been hovering around 4.5% since. So here's what we got going on in 2014. The supply is low, but is growing fast, and pretty soon I think we're going to be in a high supply situation. The demand is weakening, or weak. I would say it's weak. The delinquency rates are still very low. The foreclosures have a very small market share, but because of the rise in prices, the investors have lost interest and moved to other markets. And that also leads to fewer cash transactions and fewer out-of-state buyers. So what that means is we'll probably correct on our pricing coming up because of the downward pressure in the low demand. I hope that helps you guys understand a little bit what's going on in our current market. If you have any questions specifically about an area such as Chandler, Mesa, Gilbert, something like that, let me know. And if you're looking to sell your home and are having a difficult time, you're going to really need to take into consideration where you're setting your price and the type of buyer you're trying to capture, and adjust accordingly to that. And your agent's marketing will be very important to the success of your sale. I hope this helped, and I will talk to you later. Thanks.